Well, ladies and gentlemen, welcome back to the channel. We got a lot to talk about here in this video. We're briefly going to talk about what happened today in the markets. We're going to focus on what's going to happen throughout the rest of this week and what could possibly happen with some of our favorite companies. So, without any further ado, we're not going to waste time. Hit the like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. If you guys want to support the channel, link down below in the pinned comment for the Patreon as well. Now, getting straight into it, the S&P 500 is down about 1%. It looks like we are making a sharp recovery towards the end of the day today. We were down much more intraday, down over 2% on the S&P. On the NASDAQ, we were down over 3.5%. So we have reversed some of the losses we've seen intraday. And long story short, what caused the markets to actually head down today was Snapchat. And Snapchat basically came out with earnings last month. They guided in between 0 and $50 million EBITDA, earnings before interest, taxes, depreciation, and amortization. It's a metric to look at profitability. They guided between 0 and 50 million. They came out and they said, yeah, we're not even expecting to hit zero. We're not even expecting to hit 0 millions. Like, we're going to be negative on EBITDA. And basically said the economic conditions over the past month have deteriorated a lot faster and further than they expected in that amount of time. So essentially what that's saying is, hey, you know, Snapchat advertisers, they're not spending as much, so their businesses must not be doing as well. And that is the top headline here on CNBC. And that's what is really driving a lot of our portfolio values down into the ground. A lot of your companies where, you know, guidance is always important, but it's like, who's going to miss guidance? Who's potentially going to be the ones that are going to get hurt the most if, you know, Snapchat is advertising that their advertisers are not doing so well in their businesses? Well, it's probably going to be a lot of these small to mid-cap companies that we are invested in. So that's, long story short, what is actually happening. The markets are not falling like this because Snapchat's some big company. It's what they said about the overall economy that is not looking so good. So that's really why a lot of our portfolios are into the toilets today. Now, this actually came out as well, which this was really bad. Sales of newly built homes tumbled over 16% in April while prices soared. Sales of newly built homes sank to the lowest rate since the start of the COVID pandemic. The median price of a new home sold in April was $450,000, an increase of nearly 20% from the year before. Slower sales caused the inventory of newly built homes to jump sharply as well to a 9-month supply high. A 6-month supply is generally considered balanced between buyer and seller, and it was expected to come in at negative 1%. It came in at 16.6% drop. So this was a huge miss. Very, very bad. And it shows prices are still going up and people are still willing to pay higher prices, at least for now. But I will say, you know, when you get a home built for you, it takes a lot of time, you know, so a lot of these houses that are being built right now still, it's not necessarily that people are paying, you know, 5% interest rates. They probably locked in rates that are, you know, 2 to 3% still. So really in the next coming months, that's where you could potentially see the housing sector really start to falter in a major way. Honestly, like, people cannot afford these mortgage rates the way they are. So once you start to get the contracts that are, you know, being done and built for houses that have been secured, you know, 6 months ago, and you start to get into fresh contracts, I think that's when you're going to see a lot of home prices start to come down, and a lot of home builders will be hurt because of that, because supply issues and the price of building a house is not really coming down in the same way. If anything, it's actually going up. So that is that. Those were the two big things. You also did have Fed Jerome Powell that was actually confirmed for his nomination, and this is the big headline that you are seeing. It says Powell's soft economic landing may be out of Fed's control, and this is something that I've talked about before, but I will briefly talk about again. So the Fed has had this crash course with inflation. They want to get inflation down. But I think it's safe to say, you don't have to be like this major economist to see this, but energy prices, what you pay at the pump, as well as food prices, those are the two things that are really going to hurt the economy. Those are two things which everyone has to spend money on. If they're spending extra money on those things, they can't go out and buy a new product. They can't go out and, you know, experience new services, right? Things that really boost the economy ahead. And oil is not coming down. Oil really has never been over $100 a barrel for this prolonged extended period of time. And anytime it has been over $100 a barrel, like during 2008, what happened? Well, you had a recession. But oil was only above $100 a barrel for 3 months during 08, and it has been above $100 a barrel for 5 months from the start of 2022. So the longer this stays high, the worse things will be. And as the Fed continues to raise rates, all they're doing is putting more fuel on the fire. They're not really going to help inflation until the price of oil and food does go down, because oil touches all businesses. No matter what business you are, the price of oil affects your business. I don't care what your business is. I don't care if you're a restaurant. That's going to hurt the amount of people that are able to come into your restaurant. Or if you're an Amazon and you have to take the brunt of oil prices, of gas going up, that's obviously going to hurt. And businesses far and, wide in between, they're all being affected by the price of energy. And when a business is affected by the price of energy, they have to raise prices. In this market environment, they're not going to let their margins go down the toilet. No, they're going to raise prices. That's going to continue to hurt inflation. So what the Fed is trying to do here is not really helping the situation, we'll just call it that. And even Fed Woolard came out about 2 days ago, and he said that he does favor raising rates more aggressively to get them closer to like 2.5–3%, to get it close to that neutral rate, and then to stop raising rates around September. So that was seen as somewhat of a bullish thing for the markets, but the markets didn't really run with it because it wasn't Fed Jerome Powell. Now, tomorrow we will get more clarity on that, because why? Well, we have the FOMC minutes that do come out, as well as durable good orders month over month that comes out at 7:30 in the morning. And then here you have it, the FOMC minutes that will come out at about 2 p.m. tomorrow. And then you do have Fed Brainerd's speech. But exactly what the FOMC minutes are is essentially the transcript of the last Fed meeting. So they talk about what they want to do at the next meetings. They talk about how the economy looks, what kind of their time frame is for getting inflation down. They talk about a lot of these things. They might address, COVID, China lockdowns, the war in Ukraine, things like that. And you get a little bit more clarity into what the Fed is planning to do. And that's why it's going to be so important coming out tomorrow. And the markets always react to this, so they will react again tomorrow. And I do think in a weird way, the potentially more aggressive the Fed acts could be a short-term bullish thing, because people would say, hey, you're going to get inflation down fast. But at the same time, I think going more aggressive here is going to hurt the economy in a bigger way, unless energy prices do come down. If energy prices come down, then that will be very bullish for the markets. But unfortunately, who knows how long the war in Ukraine is going to last? That is going to dictate when energy prices do come down. It's not like the government actually wants to help people out here. They could drop the price of oil tomorrow if they wanted to, just by speaking about drilling more and opening the Keystone Pipeline. But it doesn't look like, they're going to do that. It doesn't look like the war in Ukraine is going to blow over tomorrow or next week or next month. So we can kind of anticipate, high energy prices for a while. And this is going to push us into a recession. Who knows if it'll be in the next quarter? Who knows if it'll be, later in 2022? But it will happen if energy prices continue to remain this high. And this is the golden opportunity to buy the dip for a prolonged period of time that you guys should not squander. You should take full advantage of this opportunity, because what is one thing we know? Markets always bounce back. And then on Thursday, you do have GDP growth rate quarter over quarter for the second quarter. It's the estimate. Now, this could be the indication that does push us into a recession, or at least the preliminary numbers. We've seen Q1 GDP numbers, they were negative, right? We're heading throughout, we're almost at the end of Q2 right now. So this will be very important. And I think on Thursday, this could either solidify to the markets like, hey, we're going into a recession, or Not quite yet. And in my personal opinion, we're probably already in a recession. So we're probably going to get some really good buy the dip opportunities here. If the FOMC minutes do spark a bullish reaction, then that could be good as well. If GDP is good, we could end the week on a strong note or a very bad note. The markets are very, very volatile. Even intraday today, we were down to about 386.96 on the S&P. We're now at 390.48 heading into the close of the day, taking some candles to the downside. Right now we even hit a high of about 393 on the S&P. So it is very, very volatile right here. And that's something that is very important to know. This volatility is not going to go away unless oil prices do come down in a big way, inflation comes down, and the Fed, stops raising rates as aggressively. That's when you could really logically expect all-time highs in the markets, or at least a bounce that can actually hold its own 2 feet. Right now, you're simply not seeing that. It's a slow grind down, essentially, and the Nasdaq is down almost 30% year to date. Worst stock market since 1939. So things are not looking so good at the current moment. But long story short, you want to be a buyer right now. You do not want to fumble this opportunity because everyone is scared. Remember what Warren Buffett always says: be fearful when others are greedy, and greedy when others are fearful. Now, let's briefly go over SoFi specific data and what is actually happening today and what I think is going to come out of these Fed minutes coming tomorrow, as well as the GDP data. So for the day, SoFi stock is down almost 8%, sitting at $6.70 per share. The RSI is definitely retraced quite a bit today at 46.47, so under that neutral level of 50. So that is a good thing, considering we have rallied quite substantially from the bottom at 482 that we've seen, about $2 to the upside. So to see the RSI neutraling out here is very good for a potential next move to the upside. The MACD is still extremely bullish, and you're seeing quite a diversion from the RSI and the MACD, but that is just fine. The MACD usually can, remain bullish for an extended period of time or remain bearish for an extended period of time. The RSI, the relative strength index, is much more important if you're looking at a couple day or couple week potential movement, that we would head into. Now, for the actual resistance level, that's going to be $7.66 per share. So about $1 off of where we currently are at. And we found resistance around there again. And we found resistance here like 10 times over the past, call it a year, really from November when we were at $25 per share. We've had a really hard time breaking out above the 50-day moving average. We are very close to that. I think if the FOMC minutes tomorrow are good and do indicate possibly a slowdown to Fed policy, aka the Fed slowing down raising rates some point into the future, that could be very good. And I do think there's a lot of bad news priced into the markets due to the Fed, due to inflation, the war in Ukraine and Russia, China lockdown, monkeypox. Like, there's a lot priced into the markets. You've had the worst start to the stock market since 1939. That's terrible. Terrible. And the Nasdaq does not fall 30% in 5 months, and you never see a bounce. Like, we are going to see a substantial bounce once we do get good news. Maybe it's the FOMC minutes, maybe it's something else, but I do think SoFi stock is primed to actually see that bounce. And I think there's been a lot of strong indications of the businesses doing just fine, like the insider buying, which we have talked about many, many times. And it's quite phenomenal, all of the buys that you are seeing coming in. Like, they are quite literally buying the dip. Anthony Noto, as well as the directors here, have been buying tons of shares in the company for millions and millions of dollars, even though they already own millions of shares apiece. So I think that is a very bullish thing. And one of the most bullish things that a retail investor could look forward to is insiders buying stock, because I've said it a million times, and I'll say it again. There's hundreds of reasons why somebody sells stock as an insider of a company. Taxes, divorce, vacation, houses, boats, whatever the case is. There's one reason why they actually put their money to work in fresh new stock, not part of their 10B plans, right? It's because they think the stock is undervalued and it's going to go higher. But here in the short term, there is a lot of, pressures weighing on the stock, but the insiders buying the stock probably means they're seeing pretty good numbers still coming in. Now, the short interest of free float is sitting at 19.75%. Current shares that are sold short of 143.72 million. Cost bar max at 9.25%. This is implying a decent sized move here in the next coming weeks. Cost to borrow does directly correlate with how big a potential move could be, because that's the rate that potential lenders of stock want to get paid, because that's the move they imply that they could see, right? So pretty straightforward and self-explanatory there. But the utilization is 100% and the free flow out on loan is 30.26%. So even though the short interest is only 19.75%, there's a lot of shares that are out on loan that are waiting to be sold short or actually to be returned. So if you do see market conditions really start to look better, you could see a lot of shares actually being returned, and that could, in theory, make the stock go up in a substantial way. There's about 220.24 million shares that are out on loan relative to 143.72 million shares that are actually sold short. So there's a lot of fuel on the fire, potentially both directions here, that could be shorted or, that could be returned and actually help the stock in a big way. Now, the option activity for the day, you are looking at some bullish option activity. You're looking at one order totaling $100.19 thousand, positive order value of 100% over the past week. Not looking so bullish. 47 orders totaling $9.79 million, positive order value of 34%. And just overall here, heading really into the FOMC minutes tomorrow, as well as the hopefully good economic data that comes out, I think SoFi stock, as well as the broad markets, are really primed for a substantial bounce, and I think that's why you're seeing the markets trying to claw back towards the end of the day today. I think we're looking for a reason to bounce, but we just need a little bit of good news. We are actually establishing a decent trend from the bottom here that we did hit earlier in the day. So maybe it's another short-term bottom. Maybe we crash tomorrow. Really not a fortune teller here, but what I do know is we are seeing very encouraging signs from SoFi's earnings, as well as SoFi insiders that are buying the dip, and that makes me very comfortable heading out here and buying the dip. Even though I'm still down 45% in my position, this is a great time, in my personal opinion, to be buying the dip in SoFi stock. So that is going to be all for this video. Hit that like button, subscribe to the channel, source comments, questions, or concerns down below in the comment section. If you guys want to come support the channel as well, support the journey in SoFi, and continue to make this available to spread the knowledge on SoFi stock and really spread the word to as many people as possible. Link down below for the Patreon in the pinned comment. Thank you guys for watching. Enjoy the rest of your day, and I will see you in the next one.